My name is Paddington Zinzombe. This lesson is brought to you by Gauteng Department of Education with Sci-Bono Discovery Center, and it is broadcast to you by Pakama Research and Development. This is our just-in-time program for accounting so that at least we can be in a position to bridge the gap between what we had to do in grade 10 and 11 now that we are getting into grade 12. Today's topic is going to be tangible assets. Let's go through this. Now, please take note for today, our objectives are for you to be in a position to go through the following. We are going to go through concepts that relates to our tangible assets. We are going to go through calculations for depreciations. We are going to go through management or control of tangible assets. And then we are also going to look into ethics around tangible assets, as well as an additional of asset disposal. Let's hope we are going to enjoy this. Now, to start with, let's look into what is it that we are talking of here. Tangible assets. And I think you have already been informed that these are the same that we refer to as fixed assets. Now, what are tangible assets? Tangible assets are those physical assets that are acquired by the business. And please take note, they are not intended for resale. So the minute an asset is intended for resale, it becomes stock. Tangible assets are those that are not intended for resale, but to be used for daily operations of the business in order to generate profit. We have got our examples for tangible assets, which are land and buildings, vehicles, and equipment. And please take note, we are going to be using these classifications mainly when we are referring to our tangible assets. Let's check tangible assets in pictures. What are we seeing here? That looks like an office here. Now, we have got our printers, we have got the table, the chairs, and we refer to this as equipment. Let's check to our right. Oh, that's a very nice building that we are seeing here, offices. Now, that's land and buildings. Now, at the bottom here, I can see something that looks like a boardroom table with chairs, and we can refer this to as equipment. That's referred to as equipment. Now, bottom right, what do we have here? Nice vehicles, ready for work. That's vehicles. So we can see what we are looking into when we are referring to fixed assets. Land and buildings, equipment, vehicles. Please take note. When we look into tangible assets, the value of tangible assets such as vehicles, equipment, depreciate. Now there is the term, depreciate, lose value. This is because of wear and tear caused by and resulting from daily use. So as you are using a vehicle, as you are using equipment, the value is going down because of use. And we are saying that loss of value is called depreciation. The value of land and buildings appreciates if the property is well maintained. So when it comes to land and buildings, the value is always going up, especially if it is well maintained. Now, the tangible assets will be recorded at cost, irrespective of the decline or the increase in market value of the asset. Please take note. We have got accounting concepts that tells us what to do when we are faced with different accounting situations. So when it comes to tangible assets, we are going to be using or referring to the GAA principle, which is referred to as the historic cost principle. And then what does it say? Tangible assets will be recorded at cost, at their historic cost. So we can look into this. It says the GAA principle applicable to bullet 3, which is the recording at cost, is the historic cost principle as well as our need for being prudent. Now, we need to look into concepts that we are going to be referring to as we go through this topic on tangible assets. The first thing, I think we already looked into this briefly, depreciation. What is depreciation? That is the reduction in the value of an asset over time due to particular wear and tear. As you are using it, it's losing value. So the reduction in value, we refer to that as depreciation. And then we are also going to have to look into accumulated depreciation. Accumulated depreciation is the total amount of depreciation deducted from the asset since acquisition. So here we are looking into the total value lost. The asset is losing value from the day on which it is bought until to the date which is current. So the total value lost, we refer to it as accumulated depreciation. I always would want to refer to accumulated depreciation as age. Accumulated depreciation is always increasing because, like age, it always increases. One day we live, it means our age goes up. And then we go to the carrying value, or which is sometimes referred to as the book value. Now, this is our cost minus accumulated depreciation. Original cost less the depreciation that has accumulated over the period in which the asset has been in the business. Carrying value, that is the remaining value after we have subtracted value lost. That is the remaining value after having subtracted the value lost. I think we are following up to this point, and everything is going on as we would want it to. Now, what are the reasons for buying assets? Why do the business buy assets? The first reason is if the existing assets or equipment has become old and out of date. You are having a printer there that is now outdated. You are having computers there that are no longer even compliant to new technologies and equipment. It is now outdated. We need to replace. So we buy up-to-date equipment. The running costs of current assets may be too high. We are having a vehicle that is now old to the extent that it is now consuming more fuel, or maybe it is also becoming very expensive to maintain. We need to replace. We need to buy some other equipment. Now, sometimes the business wants to just keep up with technology. Technology is ever changing. So when it changes, we need compliant equipment. So we want to keep up with better technology. Please take note, all assets bought must be recorded in an asset register. So there is another thing that we have got to look into here, an asset register. Check here. Even when you are enrolled at your current school, the first thing that they did is to make sure that they include you in that register. And they took all your details and they are found in that register. So the same happens when a business is buying new assets. They need to create an asset register where we have got information about this particular asset. So what is an asset register? An asset register is the list of all the assets that belongs to the business. A list of all the assets that belongs to the business. Now, the purpose of the asset register is to keep track of the book value of the asset. Remember, we said book value is equal to cost minus accumulated depreciation. And we said book value is the remaining value of an asset. And remember, the remaining value of the asset is always going down. So we need to check and see how much value is left in our asset. And we keep track of that in our asset register. We also have to use it to determine the depreciation to be calculated and recorded by management and for tax purposes. Now, what is it that we find? What are the details that we find in an asset register? Details in the asset register includes asset details. When was it purchased? What was the cost price of the asset? Who sold this asset to us? Details of the seller. What is the type and model, serial number, receipt number, among other things. We also need to look into the rate of depreciation because assets are depreciated at different rates. The book value of the asset, life expectancy, how long do we expect our asset to live, method of depreciation, depreciation itself, as well as accumulated depreciation. So you are going to see that when an asset is recorded in an asset register, the asset register will look like this. Now, this is our business, DM Traders, and we have got an asset. So we are going to look into which account is it recorded in. That's the vehicle account, which is B6 in our ledger. What item is it? Nissan delivery van 2 liter. And then where from? Where did we buy this from? Nissan Monument. So you can see all the details about the assets are found on the asset register. We even know the date on which it was purchased. We even know the cost price of the asset. We even know what method and rate are we going to be using to depreciate this asset from the information that is given. So as we go through now, we are going to be recording at the end of every accounting period the date, the depreciation for the year, the accumulated depreciation, as well as the book value. Now, please take note, only one asset is recorded in the asset register. So it means for every asset, we are going to be having an asset register for that specific asset. Please take note. As I said earlier, this is an interactive lesson. Talk to us, communicate with us. Tell us what is it that we can improve and where do you still need our attention on. Our WhatsApp number is 063 629 3655. I'll go through this again. 063 629 3655. Let's continue with our issues of today. Now, when it comes to depreciation calculations, we do use different methods. And for you guys, we are going to be looking into specifically two methods that are used to calculate depreciation. Now, these are the fixed method or the cost price method. Now, this takes place over the useful life of the asset at a fixed rate. So, if we expect it to be written off at the end of 5 years, then we are going to use 20% per annum, which means 20% of the value of the asset goes off every year. At the end of 5 years, the value of the asset is no longer anything that can be recorded. It will be down to zero. But now we can also use the diminishing balance method. Now, this is the method where we write off depreciation on the carrying value of the fixed asset. So we have got a certain rate that we are going to take from the carrying value. Remember, what is the carrying value? The remaining value of the asset. Cost minus accumulated depreciation. Cost minus total value that have been lost. So the carrying value is always going down. The carrying value is always going down, which means when we calculate 15% on the carrying value of this year, it is definitely going to be more than the 15% of the carrying value of the following year, because our carrying value is going down. So we are writing off of depreciation takes place over a longer period of time. Usually we wouldn't get to a point where we have got the zero value of an asset when you use the diminishing balance method. Now, when it comes to the fixed method, depreciation is the same over the estimated useful life of the asset. The depreciation for the year in question is always the same as the depreciation for the following year, because the cost price remains the same over the useful life of an asset. But when it comes to diminishing balance method, depreciation will reduce over the years. The reduced balance is used to calculate depreciation. Because we are using the carrying value, which is always a reduced value, then it is also going to be reduced over the years. Now, let's do what accounting people do. Work with figures. Let's look into example 1, where we are going to calculate depreciation using the first method, the fixed price method or the cost price method. Now, this said, information. The financial year ends on the last day of February each year. We bought a delivery van for 180,000 on 1 March 2020. So if this asset was bought at the start of March in 2020, our first year is going to be completed at the end of February in 2021. So they're saying, what are we required to do? To calculate depreciation on 28 February 2021 at 20% per annum on the cost price. So they are telling us the rate, they are telling us the method. Please take note every time. They are going to give you the rate and they are going to give you the method. Very important, because when the method change, it means 1, the cost price of the asset, 180,000. The rate, 20%. And the method, cost price method. Now let's see into how do we go about the calculation. 180,000 times 20% for 1 year, which can be given as 12 over 12, which results in 1 anyway. And then when we calculate that, it gives us 36,000. So depreciation for this asset is going to be 36,000 for the year starting 1 March, ending 28 February 2021. Now, let's check. There is an activity. Now, they're saying here, the equipment. Now, check. The financial year ended on 31 December 2020. Now, it means the financial year is starting in January, ending in December. Now, the balance of the equipment in the general ledger on the 1st of January is 90,000. So it means our equipment value, the old equipment that we have had from previous years, the cost is 90,000. And then there is a new asset that have been bought. And this one have been bought on 5 July 2020. Now, please take note, if we are having such equipment which have been brought into the business at 2 different dates, then it means when you calculate depreciation, we are supposed to make sure that we calculate 2 separate sets of depreciations depending on what we have. Now, let's start with the old equipment with a balance of 90,000 at the start of the year. Now, how are we going to go about it? 90,000 times 10%. Check, it was there at the start of the year until the end of the year, so it means it was there for the whole year. And then it gives us 90,000. And then we go to the new equipment that have been bought during the year. The cost of that equipment is 5,000. And the rate remains 10%, but please take note, it was bought on 1 July, which means it was bought halfway through the year. So it is in the year for half a year, which is 6/12. We are counting July, August, September, October, November, and December. So it means we have got 6 months. And when we calculate, it gives us 250. So after that, we combine the 2 figures. So it is going to be the total depreciation of 9,000 plus 250 to give us 9,250. Did you get that one right, class of 2022? I trust you. Hope you got it right. Now, let's move on. We are now going to look into a second example in which we are going to change the method of depreciation. We are changing the method. Nothing much is changing here, but the method. And please remember, I said check the information. The rate is going to be given as well as the method is going to be given. Now, when the method changes, it means how we calculate changes. Very important. Now, it says according to our information here, the information appears on 1 March 2020 as follows. Equipment, 40,000. This is the cost of equipment at the beginning of the year. Accumulated depreciation on equipment, 4,000. This is the total value lost so far at the beginning of the year. So we are required to calculate depreciation on 28 February 2021. So check the change in dates from 1 March, the start of the year, to 28 February 2021, the end of the year. So we are calculating depreciation for the whole year for the period of 12 months. Now, the rate is 10% and the method is diminishing balance method. Very important, method. So the minute they say the method is diminishing balance method, before you can do anything, please do me this favor. Find your carrying value. Do me this favor. Find your carrying value. How do we find carrying value, by the way? Cost minus accumulated depreciation. So the cost is 40,000, accumulated depreciation 4,000. So we can now find our carrying value. So let's check here. 40 minus 4, that's 36,000. After that now, we have got something to use to calculate our depreciation. We say 36,000 now times 10% for 1 year, which is 12 over 12. And we are getting a depreciation value of 3,600. Now, let's look into this. There is old equipment and there is new equipment. So this is old and this is new. Now, when we have got old and new equipment now, remember when calculating depreciation, let's separate the two. Let's deal with the old to start with. So what do? We find carrying value first. And why are we troubling ourselves by calculating the carrying value? It is because of the method. We are using the diminishing balance method. Why are we having to calculate the carrying value? Because we are using the diminishing balance method. Hope you got that part correctly. So how do we go about it? Let's find carrying value. Carrying value is cost minus accumulated depreciation. The cost is 40,000. The accumulated depreciation is 7,600. So we just find the difference between the two. 40,000 minus 7,600. It's going to give us something like 32,400. That is the carrying value we are going to use to calculate depreciation on the old equipment. Good. Let's go to the new equipment. Remember, new equipment have not yet lost any value. So the carrying value is still going to be equal to the cost. Cost minus accumulated depreciation, which is still at 0 at this point. It means our carrying value is going to be equal to the cost. So we are going to be using our 96,000, which is the cost, when it comes to the calculation of depreciation on the new one. But remember, the new one was bought on 1 November 2020, and our year is ending 4 months later in February 2021. Let's check if it makes sense. November, December, January, and February. 4 months. So we calculate for those 4 months. So let's check the suggested solution to this. First step on the old equipment. 40 minus 7,600 gives us 32,400. And then now, when having our carrying value now, we can now be able to use it to calculate our depreciation. 10% of 32,400, it gives us 3,240. Well done. Those that got it right. Well done. Those that missed something, that's how we learn. We learn by making mistakes. And then we go and calculate depreciation on the new asset. 96,000 for 4 months, remember this time, times 4 over 12 at 10%. It gives us 3,200. After that, we just do the last part, which is combining the two figures. 3,240 plus 3,200, it gives us 6,440 depreciation for the assets using diminishing balance method. Hope you got this one correctly. Now, let's keep on going. Now, let's go through our example that we are going to go through now, it is more complex now because we are looking at a number of aspects now. We are supposed to complete the following. One, we are supposed to calculate depreciation for the current year. That is to be calculated at the end of December. Remember, our year is going to be starting in January, ending in December. And then we are also going to record this information in the following ledger accounts: the vehicles accounts, the accumulated depreciation account, and then the depreciation account. And then we are even going to indicate how this information will appear in our financial statements. Remember, boys and girls, class of 2022, this is nothing new. This is exactly what we were doing last year when we got to this topic. And remember, nothing new going into grade 12, because we are just going to add a little bit of information. We are just going to practice more, and we are going to get into the exam well prepared. Half of what we need to know, we already did in grade 10 and 11. So the exam is still going to be examining you on those aspects. Revision, very important. Don't throw away those books and notes. We still need them. And then another half is going to come into what we are going to go through with you as required by the syllabus for grade 12. Let's check again. We are required to calculate the depreciation for the current year, to record the information in ledger accounts, and the ledger accounts required are specified, and then we are supposed to indicate how the information will appear in our financial statements. Now, information A. A new vehicle was bought for cash on 1 April 2020 at the original cost price of 300,000. Depreciation on vehicles is calculated at 20% per annum using the cost price method. Now, please, they are saying a new vehicle have been purchased. It means we are still having our old vehicles, but now let's concentrate on the new one. I said you need to check something here: the rate, the cost price, and the method. And this time the method is the cost price method. So how do we go about calculating depreciation here? It was bought on 1 April, but our year is not starting on 1 April. Our year started on 1 January because it is ending on 31 December. So we need to know how many months are there from April to December. April, May, June, July, August, September, October, November, and December. It gives me 9 months. So it is going to be calculated for 9 months. So let's see how we are going to go about it. But before we get to that, we also have got information B, which is giving us information about that vehicles that we had from the start of the year, the old ones. So you can see something have been bought in the year 2018 because we are calculating depreciation at the end of 2018. So it was bought at the beginning of 2018. The depreciation, accumulated depreciation, the carrying value. Remember, carrying value is cost minus accumulated depreciation. In 2019, we do the same. We calculate depreciation. Sorry about that. At 50,000. And what happened to our accumulated depreciation? Just like our age, it is accumulating. It is going up. So when accumulated depreciation increases now, it means our carrying value is going to decrease. So it's 250 minus 100,000 to give us our 150,000 as the carrying value at the end of 2019. Now, we are expected to calculate this depreciation for 2020, which is missing. And then it helps us to find the accumulated depreciation for the same year and the carrying value. We are going to do that and see how it goes. So we are having two pieces of vehicles, the old and the new. When we're calculating, remember, we cannot mix. We keep the old as well as the new separate. Now, how is it going to be? Now, the vehicle was bought on 1 April for 300,000, which is the new one. So the calculation of the depreciation is going to be like this: 300,000 at 20% per annum for 9 months. Remember the 9 months, right? And then it gives us 45,000. Hope this was straightforward and we got it, all of us. Now, how is this going to be recorded now in the ledger accounts as required? Remember, depreciation is an expense and it is going to be recorded on the debit side. So whenever we are recording depreciation, we are going to debit the depreciation account. And then what is going to be the contra account here? Accumulated depreciation on vehicles. So it means double entry is going to be completed in the accumulated depreciation on vehicles account. Now let's check if we can be able to calculate the next figures. Now it says here, calculation for depreciation for this vehicle B. It's going to be the cost 250,000 multiplied by 20% per annum. And remember, so it is going to give us 50,000. So it means the first question mark is replaced by 50,000. What happens to our accumulated depreciation? Remember, accumulated depreciation is the total value lost. So we have lost 50,000 for 3 years now. So it becomes 150,000. Carrying value, it's cost minus accumulated depreciation. Cost, which is never changing, 250 minus 150,000. And it's going to give us our 100,000. So it therefore means in our information, wherever there is a question mark, we can be in a position, we have got the power to make sure that those question marks changes to figures. Now, how is it going to appear in our depreciation account? We are going to do the same. Remember, it's an expense account. It is going to be debited. And the contra account remains accumulated depreciation on equipment. On vehicles, sorry. Now, we have got the new and the old. The new lost a value of 45,000, the old 50,000. When combined, it's going to be total depreciation of 95,000. So total depreciation is 95,000. Now this, we are going to take it now into our next ledger account, which is the accumulated depreciation on vehicles account. Now this one started with a balance. That's the balance brought down. Check the side on which the balance is. It's having a credit balance. So please remember, the opening balance, or the balance, is always credit. the balance in the accumulated depreciation on vehicles, it's always credit. And then we are now going to complete double entry with those items that we got in our depreciation account. Remember, the total depreciation is 95,000 for all our vehicles, new and old. Therefore, we are going to record it on the credit side because in the depreciation account we debited. Double entry rule. For every debit entry, there is a credit. When we debit one account, it means we must credit the other one. In the depreciation account, we debited, and our contra account was accumulated depreciation on vehicles. When we get to the accumulated depreciation on vehicles now, we credit, and our contra account is vehicles. Remember that. Now, how much? 95,000. After this, what's left? We just need to balance off this account. From grade 8, 9, we got to 10, 11 last year. I do trust you guys, you all know how to balance off an account. The bigger side is the credit side with a total of 195,000. So it means we also need 195,000 on the debit side for it to balance. So it means that becomes our balancing figure of 95,000. Balance carried down. But remember, the balance carried down is not our balance. The balance brought down is the balance now which is going to the credit side of that account. The account is credited. Remember, it is a negative asset. It have got a negative effect on our assets. How is it going to appear when we take it into the tangible asset note? Please take note. We are having this part which represents the start of the year. This is the beginning of the year. And then we also do have this part which is representing the end of the year. Now, having our start and the end, there is somewhere in between where we have got information for things that happened during the year. So whatever takes place during the year affects our balances at start and informs us the new balances that we are going to be having at the end. Let's look into the cost to start with. Cost at start is related to cost at end. Cost at start is related to the cost at the end. But what brings about this relationship? What links this relationship is anything that happens during the year which is also at cost. So let's go to our movements. There is additions at cost. So the only cost aspect that affects our opening cost is the addition that took place, which was at cost. So we are going to say 250 plus. Why adding? Addition plus. So it's going to be 250 plus 300,000. And it's going to give us 550. Remember, the cost at start is related to the cost at the end. The cost at start is related to the cost at the end. But what joins them is any cost aspect that we find under movements. And in this case, the only cost aspect that we found under movements was an addition at cost. 250 plus 300,000 gives us 550. Hope we are still okay. Now, next, there is also a relationship between accumulated depreciation at the beginning, this one, and our accumulated depreciation at the end, this one. They are related. But what is facilitating this relationship? What is joining these two? It is any depreciation aspect we find under movements. So let's check accumulated depreciation, there we are, and accumulated depreciation at the end, here we are. Do we have anything that is depreciation during or under movements? Yes, there is depreciation. So what happens here? Accumulated depreciation at the start is always increased by depreciation. Remember, we said accumulated depreciation is like age, always increasing. But what increases it? It is depreciation. So it's 100,000 plus 95,000. You can see where all this is coming from. 95,000 is the depreciation during the year. So 100 plus 95,000, it gives us 195,000. Now, carrying value is a result of what we have at the start or what we have at the end. So let's start with the start. What is the carrying value? The formula for finding carrying value is never changing. Cost minus accumulated depreciation, which says 250 minus 100,000, and it gives us 150,000. We take the same concept to the end of the year. Cost 550 minus 195 accumulated depreciation, it gives us our carrying value of 355. The most important thing when it comes to the fixed asset note is to understand the relationships that exist between cost and carrying value, between the cost at the start and the cost at the end, and between accumulated depreciation at start and accumulated depreciation at the end. Those relationships, when respected, usually we enjoy our accounting. Now, we want also to identify what is it that we are going to disclose when it comes to our financial assets, to our end of year information. Now, please take note. The most important figures we are going to take from here, we are going to take depreciation. And where do we take depreciation to? This goes to the income statement. Depreciation to the income statement. What else do we need? We also need the carrying value at the end of the period. Carrying value at the end of the period, which is this 355,000. Where do we take this one to? This one goes to the balance sheet. Very important. When all is said and done, when all is completed, we need to take these figures to where they belong. So when we are showing disclosures in our financial assets, we are going to take our depreciation into the income statement under operating expenses, and it appears just like this. And then we also remember the balance sheet. We take the tangible asset figure, the carrying value, under non-current assets as tangible assets, just like this. So remember, when we are busy also doing this, we are having a run up towards preparation of financial statements. Having said and done this, let's move on to another very important part of tangible assets, that of internal control. Very important. How do we go about safeguarding the assets that we have as a business? Remember, these are assets that we are buying as a business for use. The longer we use them, the more they generate profits for us. The more we keep them safe, the more they are going to be very useful for the business. So let's look into these pictures. There is my building. I can even see a for sale sign on this building. But is it looking nice? Dilapidated. Something is not right. Someone is not taking good care of this business. Let's look into the picture on our right side, the top right. Oh, there it is. Someone decided on coffee in the office, and there is the laptop. Now the laptop is now busy drinking the coffee instead. Is this person taking good care of the asset? I don't think so. Let's go down. The last picture there is a vehicle. What I'm seeing more is the cloud that is following this vehicle, smoking badly. Can we say whoever owns this vehicle, or whichever business which is owning this vehicle is taking good care of this asset? The answer goes to no. So it is very important for us to be in a position to know how we safeguard the assets that the business needs so much. Because the more longer we have those assets, the better they can be able to generate profits for us. Now, so how do we go about safeguarding the assets of our business? One thing that is very important when it comes to internal control on tangible assets is authorization when it comes to buying of those assets. Think of a business where everyone just decides, I am going to buy a new laptop, I'm going to buy a new vehicle, I'm going to buy new equipment because I saw it and it looks nice. There is need for a line of authorization so that who authorizes the purchasing of such equipment whenever a business is operating. Proper authorization. And then 2, an internal auditor must ensure that proper records and documentation relating to fixed assets are in place. Which document comes to mind? Do we still have the records? Okay, the source documents, are they in place? And then the first record, asset register. You still remember, right? The asset register and whatever information is contained in that asset register. Is it in place? All fixed assets should be recorded in the fixed asset register. So we need proper records, and the fixed asset register comes to mind as one of the very important register. All receipts and invoices should be proof of purchase so that we can use these when it comes to insurance claims or as well as external audit purposes. It is very important to always ensure that the source documents relating to all our tangible assets are in place. And then we also need to to make sure that fixed assets purchased must be labeled, or barcoded, or have a serial number given for identification and verification purposes. You know, we have got other assets that are easily identifiable, like when you buy a vehicle, it have got a lot of identifying features. We have got the plate number on the vehicle, which says BC95 GP. We know that's the vehicle. We have got the VIN number, we have got, so it's easily identifiable. But think of when you buy a table, when you buy chairs, those ones, they don't have a serial number, they don't have any barcode. So a business must be in a position now to come up with a certain identifying features which is going to be put on that asset so that we can be in a position to identify this asset. So that when a chair moves from one office to the other, we can be in a position to locate it and know it is supposed to go back to the office that it is coming from. Verifying details on assets. And then, very important, we need regular stock taking of assets so that we can compare these to asset registers. It's no use to keep on bragging and say our company is having 10 vehicles when there is none in your garage and you don't even know where the 10 vehicles are. So once in a while, we need all our vehicles in place and we can be in a position to do the physical stock taking of assets. The same applies with any other type of equipment. Our laptops, our equipment, our computers, our chairs, our desks, we need to know exactly where they are. And then we also need signing in and out of assets to check where they are and who uses them, especially when we are dealing with movable assets. We are busy as a production company and we have got cameras. These can easily be stolen if they are just going to be let out of the company premises without us knowing who signed for them and who is safeguarding them. Vehicles, if someone can just get the key from the holder and drives out without signing for, so all our movable assets, it is very important for us to have a system where someone signs for these and we can be in a position to tell who is having what asset where and when is it coming back. Movement of assets must be recorded in a logbook, e.g. vehicles. And then all fixed assets must be insured against things such as fire, theft, natural disasters, among other things. Please take note. These are our internal controls, ways in which we can safeguard and make sure that our assets are taking care of us, are generating more profits for us. We also have got ethics that relates to tangible assets. So we are supposed to put in place rules and regulations which prevent the employees from defrauding the business. And this can be done through using fixed assets for personal gain. Of course, we have got vehicles. Of course, someone has signed them out and we know the vehicle went out with who. But what is the person doing with the vehicle? Instead of going 20 kilometers away for a collection, the person drives it for 400 kilometers away. And one is using that vehicle, using the fuel of the business in even wasting the time that the business is supposed to be having for this employee. So let's have rules, let's have policies, let's have regulations in place so that using of business fixed assets for personal gain can be minimized, if not eradicated at all. We also need to check incorrect recording of kilometers traveled using business vehicles. very important to put in regulations in place, policies in place, so that people, when they record, they don't just think of a kilometers from their head, but there is evidence so that we can be in a position to tell who have been using and for how long, and if whatever the person was doing with the vehicle warrants the number of kilometers that are being indicated on the logbook. And then irregular fuel consumption by certain vehicles used by employees. Let's have questions when we can see an employee is just supposed to be doing a function that takes him 20 kilometers away, and then we check and we can see that the full tank is no longer there, because some employees have got this thing of even draining the fuel out of the vehicle, or maybe covering other distances that have not been agreed to by the employer. Then that will end this part on ethics. Now we are moving on to the last part of the lesson, where we are looking into disposal of assets. Please take note. We still have got 20 minutes to go. Let's keep tuned in and let's keep on interacting. Our WhatsApp interactive number is 063 629 3655. 063 629 3655. Now, on disposal of tangible assets, remember, fixed assets are not purchased for the purpose of resale. That's not why we are buying a vehicle. That's not why we are buying equipment. We are not buying for resale. But this pertains in the normal course of running a business. However, at some point, we may find that we no longer need this asset. Is it going to be viable for us to just keep it for the sake of keeping it in the business? This vehicle is now too small for our functions. Are we still going to keep it because we have got to keep it? This computer, it's no longer going to be useful for what we do as a business, but someone else might need it somewhere. So sometimes when we no longer require assets, we may decide to dispose or sell the asset. So that is very important. At some point, even though the asset was never bought for resale, we may need to sell, and we call that asset disposal. Now, how do we go about disposing assets, and what are those reasons that we have for disposing assets? The existing asset may be too old, or it had outlived its useful life. It's no longer useful for us. Someone might find it useful, yes, but for us, it's no longer useful as a business. Vehicles may have been involved in accidents. Either it's written off, or it have been taken over by our insurer and then we are going to claim from them, or maybe it's no longer what we would expect as a business to keep having as a vehicle after the accident. Damaged assets that cannot be used by the business anymore. It have been damaged and we can no longer be able to use it. The asset may also be obsolete. An asset that is still there, still functional, but it's no longer compliant to our requirements or our needs. And then the existing asset may be too old, or it had outlived its useful life, as indicated in the first bulletin. Okay, now, how do we dispose and where do we record such a disposal? We can dispose an asset by selling it for cash, sold for cash. An asset is sold for cash. Where do we record such an asset? Remember, the bank is involved. Whenever there is movement of cash, our bank is involved. So this is the account affected. The asset can be sold on credit. Sold to someone who is promising us that I'm going to pay you later. Now, remember, when we sell anything on credit, then we are creating an asset called a debtor. So we need to record this in our debtors control account. Debtors control account when it's sold on credit. An asset can be donated. We no longer need it, but that other organization which have got no money to buy it still need that asset. So we donate. This goes into a donation account. This goes into a donation account, which is an expense for the business. Sometimes the owner may decide to take the asset for personal use. Whether it's still useful for us or it's not, the owner may decide to take it for personal use. Then in that case, this is regarded as drawings. This is regarded as drawings, and it affects the equity of the business. And then it can be traded in. You know the concept of trading in, where you are going to give away the asset in exchange for another. And usually it comes with a top up. So this goes and is recorded in the creditor's control account. This is recorded in the creditor's control account. Sometimes it is scrapped, it's written off, it's like there is no more value left on this asset. So it's the same as throwing it away. Now in this case, we write it off. We write off the asset because there is no payment expected and will be received for such an asset. When an asset is scrapped, then we are going to write it off. And then an asset can be written off because of damages, like a car involved in an accident. And usually, because remember we said in our internal controls, it is very important to always insure our assets. So we go and claim from the insurance. So it is going to be claimed from insurance, so it becomes our accrued income. It is recorded as accrued income. The minute the insurer is approving it to say, okay, we are going to give you 120,000 for this vehicle that you lost, then it means we are going to be waiting for that as income. It is recorded as accrued income. What does an asset disposal look like? There it is. We can dispose either our equipment or our vehicles. Now, the cost price of our equipment or our vehicle is recorded here. We are going to record the cost price of our equipment or vehicle. Remember, the cost price is that amount that we paid for the asset. And because of that, it is never changing. Whenever we bought it at so much a cost. And usually when you are expected to prepare an asset disposal account, this one is given. And then that is the only entry that we are going to be having now on the debit side to start with. And then on the credit side, the first entry that we need is the accumulated depreciation on equipment or on vehicles, depending on what is it that we are disposing. So accumulated depreciation on the credit side. Cost always on the debit side. Please take note of that. Cost on the debit side, accumulated depreciation on the credit side. Please take note, when you are looking at this, we need the accumulated depreciation on the date of disposal, on the date of sale or disposal. We need the one on the date of disposal. Very important. Because sometimes they give you the accumulated depreciation on another day, which is not the date of disposal, but we need the accumulated depreciation exactly on the date of disposal. And then here we indicate now how are we disposing the asset, still on your credit side. If you are selling it for cash, bank. Selling it on credit, debtors control. If you are exchanging it, then creditors control. If you are donating, donation. If you are giving it over to the owner, then drawn. So it depends now, whatever I have indicated before to say this is how we can dispose, then it's going to be indicated here. And we are just going to indicate how much is the value that we are accepting in exchange for this asset. And then please take note. Now this figure here, the loss on sale of an asset is a balancing figure. Now this is a balancing figure. We can only have it if there is a difference between the cost and the total of accumulated depreciation and bank, all debtors control, all any other disposal way. So if we add these two figures, accumulated depreciation and this, and they are less than the cost, then we are going to result with this figure, which is the loss on sale of an asset. But it might happen that when we add these two figures, the accumulated depreciation and this amount received for the disposal of the asset, then it becomes more than the cost. In that case, this balancing figure moves now to your debit side. And whenever that happens, this becomes profit on sale of asset. The minute it is going to have a balancing figure on the debit side, it becomes profit. So if it's on this side, it's loss, but the minute it moves to the debit side, it becomes profit. So here we are saying profit on sale of an asset is recorded on the debit side of the asset disposal account. Please take note one thing that you should always be in a position to take note of. This is one of very good accounts to prepare in accounting, because you know there are going to be 4 entries only here. The cost, accumulated depreciation, how much you are disposing it, and the balancing figure. So it can be more than that. The minute you have got more entries, it means now you are busy doing things that are not correct. This only signifies the format of the asset disposal account. Now, please let's look into when do we sell our tangible assets? When are tangible assets sold? It is very important now to be in a position to see when are we selling our tangible assets. Because when we are selling our tangible assets also affects our carrying value. It also affects our accumulated depreciation on that vehicle specifically. It affects our accumulated depreciation on that vehicle specifically, which also affects our carrying value. Now, what do I mean by this? Let's assume you are having an asset that you are selling at the beginning of the year. It therefore means we can use the the accumulated depreciation at the end of the previous year as our accumulated depreciation without a problem. But if an asset is sold during the year, it means now the accumulated depreciation that we have at the end of the previous year needs to be adjusted to cater for depreciation that took place between the start of the year and the date of disposal. Very important. When the date changes, accumulated depreciation changes. When the date changes, accumulated depreciation changes. The same applies when an asset is being disposed at the end of the year. It means we are going to have the accumulated at the start and add or adjust for accumulated for the, depreciation for the year. It is very important. So remember, what is it that you need as indicated into the format that I gave you earlier when you are preparing the asset disposal account? 1, you need your cost of that asset. And 2, and very important, you need the accumulated depreciation. So if you miss the accumulated depreciation figure, it therefore affects your profit or loss on disposal. So you always need to make sure that you have it right on accumulated depreciation on the asset. And then this is what you look into. Is the asset being sold or disposed at the beginning of the year, at the end of the year, or it is being sold at the end of the year? Now, an asset disposed at carrying value, it means there's no profit or loss. An asset that is sold at its carrying value, it means there's no profit, there's no loss. But if an asset is being sold at less than its carrying value, then we are having a profit. When an asset, when it's being sold at more than its carrying value, we are having a profit. More than carrying value, profit. Less than carrying value, then we are having a loss. Less than carrying value, it means we are having a loss. Thank you for watching this lesson.